Good afternoon, Scott Redler, T3Live. Welcome to today's recap. So we came in today early on with the futures up. Everyone tried to pound those spiders, me, myself as well, figuring, okay, up open, real weak last week. Trade is, or the good book says, short the open. Plus you had Apple down $6, $7 or $78. You know, NASDAQ was weak, and it really confused a lot of traders, including myself, including everyone out there, because the trade has been, you know, NASDAQ has been strong, Q's strong, high beta strong, industrials, home builders, you name it, materials all weak, OAHs, refiners, and you know, we're in the last week of a quarter, so composure starts to change. What's going on here? Who knows exactly, but is it, you know, money positioning for what could be a fourth quarter bounce for some of these beaten down, you know, areas that they could be judged on for the quarter versus the year because they're not involved and they got out of the way for the debacle? Is it just a bit of a marking up because, again, quarter's over Friday, plus you have the mutual buy-only funds that get judged for the year on Friday? Are they trying to protect some of their, whatever it is they're trying to protect because we're down a lot, either making it a little bit look a little bit better, or are they stuck with cash and they have to put it to work, otherwise they'll lose their allocation next year? But, you know, put it all together, and the indices held up well. A lot of people are like, oh, it's low volume, oh, this, oh, that. You know what? It still hurts if you're short in low volume. It still hurts if you're trying to, you know, do the right thing and maybe fade weakness on light volume, but it's going higher. So there was no reason to fight. Once we started to take out that 1142 to 1145 area in the spiders, you had to cover. You had to say, okay, you know, I'm wrong. I'll try and fight again another day. A lot of people had short in the brain. That's fine. But the fastest traders, you know, switch gears, whether to switch gears and go the other way and make money or just get out of the way and limit your losses. So you saw the most beaten down sectors that we went over in the morning call today have the best bounces because they were the most heavily shorted and their rubber band has been stretched to the ringer. So if you take a quick look here, I'll go over them real quick. First of all, here's the SPX. Now, I talked about this small double bottom potential, okay, as we came in from this push-through failure down 100 handles or so. What would it mean? How far will we go down? We never even tested the low from Friday, so now we're right back testing this broken trend line. So we closed on our highs. You know, chances are they're probably going to push the envelope a little bit more because they always do. You know, the gap gets filled here right around 1166, and then I would say there's some a real rubber match has to happen, you know, right around here. But so I would say today's type of action had to make you a little bit more neutral versus just bearish. Doesn't have to get you bullish, but at least gets you out of the way. So especially when you close here, because we could easily open up through it. So hopefully you covered some shorts, you didn't fight it, and you did see some decent, you know, you saw red dog reversals in all the weak sectors. So I don't care if it's a new bull market. All it is a micro trade. And in my midday note, I talked about how a micro bullish bias doesn't mean you have to have a macro, you know, take that we're going to be back off to the races. And you saw great strategies that we all know near and dear to our heart, like the OAHs today, finally gave you that red dog reversal. You take a look here. This is what I mean. I'm not saying you should have been buying it here. I'm not saying it wasn't a great short when you had this wedge get resolved to the downside, but you had a nice move lower into a big support area. I guess I outlined this back here. I'm not even going to get into that. And then it reversed. The strategy was you buy 108.31s, which is the low of these 2 days, because what did it do? It took it out when as low as 106.16. So I'm going to explain this pattern real quickly and why it works well and there's a lot of action. OAHs have gotten crushed. Weak sector, weak area. Who knows? Oil could go down below 70, and the street's forecasting it. But from a move from where it was at 155 down to here, you know, it's oversold. So people who've been trying to play a bounce typically put stops in at the low of moves because you never know. It could have broken those lows, 106, it could have went to 100, and you have to be prudent. So when it goes through that 106, it steals stock. It triggers you out of your longs. And then anyone who says, oh, we're going down to 102, we're breaking 1101, this is the weakest group, we're going to press it, they get short. But meanwhile, we just had a big move, so you're playing with fire. So once it comes back above there, you have longs that got their stock stolen, you have shorts that are trapped, so it makes an action area for a day trader to make money. It could be a great day and a half strategy, or sometimes it's a new inflection point. So you go back to the chart, you look here, you will see right now all it was a really good day trade. You know, I think I went long around 108.31, and it closed at 113. That's 5 points. The OAH is 4 or 5%. And now if it wants to continue, you could see a move to close this gap and maybe and then some. So I took some long. This is a strategy. Let's see if we get some follow through. If you look at the MU, which is the agriculture group, same type of trade. This group has been annihilated. And it also tried to break below 44, closed on the highs, and has some room, if it wants to get into this gap and potentially test this area, for a nice micro trade. Doesn't mean it's going to go back and go through the roof and make 52-week highs. What it means is you have an action area in the bottom end of the range that's calculated that can give you a nice push. As far as some of the other groups, didn't make new lows. XLF was strong Friday, and it held in there today. Banks had second day. Good follow through if you took it. Even the materials, the XLI, if you take a quick look here, or the industrials, they didn't break the low. Okay, so that's why they're already in the gap. So if you broke the low, you're not in the gap yet. If you held the low, chances are you're filling the gap. So that's how you overlay these type of patterns. And we'll see if it has a room back up to here. This is what I drew this morning with Alex. If you look at the XLF, you'll see the two. This one overshot and already filled the gap, and now it's heading into some bigger resistance. We'll see how that handles it tomorrow, whether or not we open up or we open down. As far as Apple, a lot of weakness, a lot of talks about talk about the supply chain and the iPad, and the stock's been holding up really well. So who knows why it came out, but it took it in stride. It closed over 400, and it held its 20-day moving average, and so did Amazon. So with all the hoopla about Apple, you take a look here. All it did is fill this gap and held the 20-day. The market's below the 200-day, the 50-day, and here we are holding the 20-day, and people think like, oh my goodness, Apple is on its deathbed, but meanwhile, look where it is. It still looks good. So it can continue higher. It's basing after making a nice move from this area. Amazon also looks good. Amazon also touched its 20-day, and I know it was erratic today, held the slower area, and look where the markets are. The markets are at the bottom ends of the ranges, so this is still holding up well, even though the NAS was a bit off, earlier on, and it looks okay. Baidu and Sina broken, maybe they bounce. Caterpillar, I got in there for a trade also. We'll see what this leads to. It has room to fill this gap back up to about 79.24 and then about 80 plus. So all in all, here's the scoop, guys. We're not saying that the lows of the year are in, but you don't always have to put yourself out there like that. What you could say is we have a high probability setup. Red dog reversals, 80-20 trades, outside days. Same way we had an outside day last Tuesday when we broke out and failed, and it was a time to take off some longs. Today, in a lot of groups, we tried to go down, couldn't, closed on our highs. That's a time to cover some shorts and then figure it out and maybe flip and get long. If you look at silver and gold, in that note I said if you're short, congratulations, but don't be a pig. Cover some. Big move lower in these type of scenarios. So if you look here on the GLD, didn't quite get to the 200-day, but look where it came from, and where it found some support all the way down into this prior breakout. So I took a little bit long. I'm not expecting much, maybe 162-ish. We shall see. I remember I did it on this bar also. I know it was a different market then, and it led to a nice move. I'm not looking for it to do the same thing, but we could see a bit of a move there. And silver actually even had a stronger bounce, but it was just so annihilated from where it came from. I would just treat this as a trade. If you made money long it, I think you stole something, congratulations, and perhaps you get a move back to retest this gap, but since it's so high, it doesn't get filled, but gives you a bit of a trade. So we're traders. We're here to make money. Doesn't always mean you need to be involved in the same trade for a sustained move. You could do it for a 1 to 3 day time period. That's our sweet spot. If it develops into more, if there's commitment to the move, if we see better volume, if we see it broaden out, you know what? Perhaps we will be in a longer. But for now, you had a reversal near the bottom. We held the lower end of the range. You saw some decent patterns and strategies that we follow, trigger, stick with them. And then once we get up to maybe 1162 to 1165, we'll see how the market looks there. And then I think there's going to be a rubber match in the indices around 1175. That'll be the last stand to have the bears put any kind of control in. Otherwise, everyone's going to be bullish all over again. And then they'll make as many people as they can be confused. So it's all right to be confused. It's all right to be frustrated. But you get put out of business if you're stubborn. This has been Scott Redler, T3Live, the recap. See you at the morning call. Have a nice night.